Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, November 19th. Since the start of September, approximately 80% of the stocks in the S&P 500 has suffered a decline of at least 20%, while nearly 50% of the S&P 500 has experienced a drop of at least 40%. To be sure, there are a lot of cheaply priced stocks right now, yet that doesn't mean they still can't get cheaper. So what is a prospective investor to do in an environment where there are a lot of cheaply priced stocks, yet fears are prevalent that they could get cheaper still on account of forced selling and/or deteriorating fundamentals? A lot depends on one's risk tolerance and time horizon. Now, no one likes the thought that a new investment could quickly decline in value, perhaps by as much as 20% or more. Yet that is the character of the current market, which is operating on the accepted belief that things will get worse before they get better, and that earnings estimates haven't been adjusted properly to account for that likelihood. History suggests, though, that anyone with a 5+ year time horizon is being delivered one of the most attractive investment opportunities that they will ever see with this sell-off. 5 years is a long time, though, for the current generation of investors that lives for the immediate gratification of the senses. Accordingly, we have put together a list of some tips for bargain hunting in a stock market that is riddled with uncertainty and where the headline bias is such that it seems things aren't going to get better for a very long time. The emphasis here is on what we'll call the peace of mind factor. Stock prices could go lower still, but remember, the market cuts both ways. It could also rip higher in a short period of time as the fear of being invested gets supplanted by the fear of not being invested. With that, here's a 6-pack of tips that can provide some peace of mind when trying to bargain hunt or simply invest in this market. The first tip is do something. Now, this approach runs counter to the approach of doing nothing, which hindsight shows was certainly a winning strategy the last 3 months. However, Warren Buffett recently admonished investors that cash is a terrible long-term asset that is certain to depreciate in value. Doing something, that is, investing in a stock you have long wanted to own but always thought was priced too high, provides the psychological relief of knowing you are invested during counter-trend rallies that can be and have been material in nature. 2. Wade in, don't dive in. As noted above, the lesson of the past 3 months is that cheap stocks can get cheaper still when earnings prospects remain in question. Doing something, though, doesn't mean it has to be an all-in approach. Take a smaller position. This gets you some skin in the game, so to speak, but reduces anxiety about losses in the event the stock trades lower in the near term. 3. Buy what you understand. There are cheaply priced stocks across all sectors. Buy stock in companies whose businesses you understand versus taking a flyer on the stock of a company that you think might move up more in a market rally, but whose business you don't understand. Remember, you trade stocks, but you invest in companies. 4. Seek compensation. Capital appreciation might be elusive in the near term, but the payment of a dividend provides some compensation at least while you wait. 5. Apply your own discount. Look at a company whose consensus earnings estimate has already been cut at least 10% and then reduce that estimate by another 20%. If the corresponding PE multiple is still below an historical average, you can feel better about the idea of having invested in the company at a reasonable price. Both earnings and the stock price should ramp up in a more normal operating environment. And 6, diversify your holdings in a single investment. If one's resources and risk tolerance are limited, exchange-traded funds, which trade like stocks, offer a straightforward way to increase exposure to an asset class or specific sector and reduce the uncertainty of wondering whether you picked the right individual company within a sector. I'm Pat O'Hare for Briefing.com. Thanks for listening.